Imagine you are looking at a dashboard. The engine is just screaming, you're redlining, and the instruments are telling you you're about to break the sound barrier.
Sounds like a great ride.
Right. But then you look out the window, and the vehicle is somehow sliding backward down a steep hill.
Yeah, that is a wildly jarring mechanical contradiction.
Exactly. And that is exactly what we're dealing with in the market today regarding Broadcom. Ticker AVGO. We have this equity research report from late August 2026. And, the disconnect it highlights for you as an investor is just genuinely tough to reconcile.
It really is. The tension here is basically between the physical reality of a business that's pulling in billions of dollars and, the forward-looking psychology of investors who are just terrified of a cyclical cliff.
Because on one hand, Broadcom is projecting like an 84% year-over-year revenue growth for its next quarter.
Which is massive.
Massive. But on the other hand, the stock has recently plummeted over 25% from its highs.
Yeah.
And some of the most sophisticated capital on Wall Street is aggressively fleeing the scene right before a huge catalyst, their September 2nd earnings report.
Right. And the market is rarely wrong by accident, especially when you see this level of sophisticated capital moving around. We're looking at a classic standoff. Current fundamental execution is colliding violently with this macro-level paranoia about AI infrastructure spending.
So let's look at the raw numbers on the screen to frame this because it's wild. As of August 21, 2026, Broadcom sits at $368.45. It's down about 6% over the last 5 days, nearly 12% over the last 13 weeks.
Yeah.
And it is a full 25.6% below its 52-week high of $495.
Yeah.
Now, in a vacuum, you might just call that, a harsh technical correction.
Sure.
But the actual business operations present a totally different reality.
Yeah.
Q2 of fiscal year 2026, their standalone revenue was $22.19 billion. That's a 48% year-over-year increase.
It's an incredible growth.
And their guidance for Q3 is $29.4 billion.
Yeah.
So the friction's obvious here. How does a multi-hundred-billion-dollar company forecast nearly doubling its revenue only to watch its stock chart completely break down?
Well, the breakdown is being driven by what we call a severe sentiment overhang. It's fueled by the behavior of the people who theoretically have the absolute best visibility into the company's future.
The insiders.
Exactly. The research flags a highly concerning pattern of insider selling. We are looking at 52 separate open market sales by Broadcom insiders recently.
Wow.
And that totals over 715,000 shares.
And the buy side of that insider ledger is virtually non-existent, right?
Basically zero. One single purchase of 1,000 shares.
So the executives, the board members,
Yeah.
the people who actually see the daily order flow and the contracts therein, they are systematically reducing their exposure right ahead of this massive revenue quarter.
Which naturally forces institutional investors to ask, what do those insiders see on the horizon that isn't showing up in the current quarter's guidance?
Right.
Insiders diversify for plenty of mundane reasons, paying taxes, buying houses, but the sheer volume here has triggered major alarm bells for the smart money.
Yeah, the report mentioned Dan Loeb's hedge fund, third point. They entirely liquidated their position ahead of the Q2 results.
Completely out. And you also have D.E. Shaw, which is a massive quantitative fund.
They rely heavily on, algorithmic pattern recognition, right?
Yes. And they slashed their position by 58%.
Wait, 58%. When a quant fund like D.E. Shaw cuts exposure by over half, they aren't making an emotional call.
No, not at all.
Their models are detecting a high probability of a severe multiple compression. They're pricing in hyperscaler CapEx cyclicality.
That's the exact phrase. They are assuming that Google, Meta, OpenAI, that they're pulling forward years of infrastructure spending into this current AI arms race.
Creating a massive revenue bubble for Broadcom.
Right, a bubble that will inevitably pop once the initial data centers are fully built out. The market is fundamentally treating Broadcom's AI revenue as a one-time cyclical boom rather than, a permanent structural shift.
So it creates this technically oversold setup right before earnings. But it's an oversold setup built on the fear that the music is about to just abruptly stop.
Exactly.
To really evaluate if that fear is justified for you, the listener, we have to look past the ticker symbol and actually dissect their revenue engine. The billions pouring in aren't magic.
No, they're highly technical.
Right, they're driven by two specific pillars: custom AI ASICs and networking silicon. Let's start with a custom ASIC that's application-specific integrated circuit. This is where Broadcom has built a massive moat.
Yeah, the fundamental architecture of an ASIC is what makes it so lucrative here. A standard GPU, like NVIDIA's flagship chips, those are designed to handle a wide variety of complex parallel processing
They're
tasks.
highly adaptable.
Right, highly adaptable. But a custom AI ASIC is physically hardwired at the silicon level to execute one specific repetitive AI workload with just ruthless efficiency.
Because the logic is actually baked into the hardware rather than just being software instructions.
Exactly. So it operates much faster and consumes significantly less power for that one specific task.
But Broadcom isn't just stamping these things out and putting them on a shelf at Best Buy. The research really highlights their deep, long-term design contracts with Alphabet, Meta, OpenAI.
Yeah, they are essentially embedding their own engineering teams inside these hyperscalers.
Co-designing the architecture from the ground up to match the client's specific software stack.
And that deep integration is the main counter-argument to the cyclicality fear. When Broadcom designs a custom chip for Google, they are inextricably linking their silicon to Google's proprietary AI software ecosystem.
It's not a generic part you can just swap out.
Not at all.
Which brings us to the networking side, the other half of this equation. And honestly, it might be even more critical. You can have thousands of the most efficient ASICs in the world, but AI training relies on distributed synchronous processing.
Right, the models are just too massive. They have to be split across thousands of chips simultaneously.
So the bottleneck in AI training isn't always the compute power, right?
No, it's often the data transfer rate. When thousands of chips are processing a massive large language model, they have to constantly share parameter weight updates with each other in real time.
And if the network stutters for even a microsecond,
The entire cluster just sits idle, burning millions of dollars in electricity while doing nothing.
wow. And the capital being deployed to prevent those bottlenecks is staggering. The sources note that Alphabet and Amazon alone are collectively pouring $420 billion into AI infrastructure.
It's a gold rush.
It is, and a substantial portion of that capital expenditure has to flow directly into Broadcom's networking silicon simply to act as the nervous system for these data centers. Broadcom dominates the high-speed Ethernet switches required to keep data moving without packet loss.
So when you combine the custom ASICs with that dominant Ethernet switching, management's financial targets start to actually make sense. They're targeting $56 billion in AI revenue for fiscal year 2026.
And scaling aggressively to over $100 billion by fiscal year 2027.
Right.
But that $100 billion target is entirely dependent on those switching costs we just touched on. I mean, if Meta decides they want to move away from Broadcom, they can't just unplug it and swap in a competitor's hardware.
No, because the ASIC was co-designed for Meta's specific architecture. Moving away would require Meta to fundamentally re-engineer massive portions of their own software and hardware stack,
The switching costs are astronomically high.
which creates a structural lock-in. And that lock-in is what theoretically transforms these from, one-off cyclical hardware sales into multi-year recurring revenue streams.
Okay, so generating billions in revenue is impressive, but retaining it is where Broadcom's unique financial architecture comes into play. The margin profile outlined in this research is genuinely exceptional for a hardware company.
It's more like a software company.
Exactly. They operate at a 68.35% gross margin and a 38.85% net margin. But the metric that really blew my mind is their capital expenditure relative to cash flow.
Yeah, the capex is surprisingly low.
Over a 6-month period, Broadcom generated $18.753 billion in operating cash flow, but they only spent $481 million on capex.
Generating nearly $19 billion in cash while spending less than $500 million to maintain the operation.
How is that even possible?
It's the direct result of their fabless semiconductor model. Broadcom owns the intellectual property, the chip designs, the networking architecture, sure, but they hold zero physical manufacturing footprint.
So they outsource the actual fabrication to foundries like TSMC.
Exactly. TSMC absorbs the multi-billion-dollar capital depreciation of building and maintaining those physical plants, while Broadcom just captures the high-margin design revenue.
So the mechanics of that fabless model mean an exceptionally high percentage of top-line revenue just flows straight to the bottom line as free cash flow. The research cites an $18.272 billion 6-month free cash flow proxy.
They are structurally engineered to be an asset-light cash machine.
But there's a huge but here. That pristine cash flow generation sits right next to a massive liability on their balance sheet.
The debt.
$64.9 billion in long-term debt. I mean, in a high-interest rate environment, carrying nearly $65 billion in debt while operating in a historically cyclical industry. That is a highly aggressive capital structure.
It is.
If there is a sudden deceleration in hyperscaler spending, that debt load fundamentally alters their risk profile.
Absolutely. Debt of that magnitude severely restricts your financial flexibility. If a competitor makes some sudden technological leap, or if macroeconomic conditions force a contraction in overall tech spending.
Broadcom can't maneuver as nimbly as someone with a clean balance sheet.
Right. A significant portion of their operating income is permanently spoken for just to service the interest.
The counterargument from the bullish side, though, relies entirely on the velocity of that cash flow we talked about. If you take that $18.2 billion in six-month free cash flow and annualize it, Broadcom is generating well over $30 billion in free cash flow a year.
So yes, the debt is objectively massive, but their deleveraging capacity is equally massive. Assuming the AI or revenue engine doesn't stall out, they have the internal cash generation to aggressively pay down that principal without needing to tap equity markets or, restructure.
But the assumption that the engine won't stall is exactly what those exiting hedge funds are betting against.
Right.
The structural risk here goes way beyond just the debt. It's the customer concentration. The entire AI growth narrative is heavily tethered to a tiny handful of hyperscalers. Google, Meta, and OpenAI are driving the bulk of this specialized demand.
And that concentration risk creates the potential for a catastrophic revenue cliff. I mean, think about it. If Google decides their internal engineering teams are finally sophisticated enough to bring their TPU design entirely in-house without Broadcom's IP.
Broadcom doesn't just see a slight dip in sales.
No, they lose billions in recurring revenue overnight. And there is no broad consumer market to absorb that excess capacity.
That vulnerability is compounded by the valuation metrics right now. With a trailing 12-month price-to-earnings ratio of 68.35 and a price-to-sales ratio of 26.55, the stock is priced for absolute perfection.
It is. When you trade at nearly 70 times earnings, the market models literally zero margin for error. Discounted cash flow models at these multiples are incredibly fragile.
So a 5% miss on top-line revenue growth doesn't just result in a 5% drop in the stock price.
Oh no. It triggers a violent re-rating of the entire valuation multiple. The market instantly adjusts its terminal growth assumptions downward, which is exactly why quant funds like D.E. Shaw are reducing exposure.
The asymmetrical risk is heavily skewed to the downside if they miss even a single metric.
Exactly.
Yet we see other institutional capital taking the exact opposite side of that trade. The research highlights David Tepper rotating capital out of SanDisk and directly into Broadcom.
Yeah, that's fascinating.
Tepper is looking at the exact same customer concentration and the same debt load, but he clearly believes the multi-year AI tailwinds and that $30 billion in annualized free cash flow outweigh the fragility of the multiple.
It really just illustrates the deep divide at the highest levels of institutional investing. It is a fundamental disagreement on whether AI infrastructure is a temporary build-out phase or a permanent foundational shift in global computing.
Which brings us to the immediate catalyst that will likely force a resolution to this standoff. The September 2, 2026 earnings report.
Everyone is watching this.
The market is going to demand intense clarity across three specific metrics. First, they have to hit the overall Q3 revenue guidance of $29.4 billion.
The top line is non-negotiable at this valuation.
Right. Second, the market will isolate the AI-specific semiconductor revenue. Management has targeted $16 billion for Q3.
And any weakness in that specific segment will totally validate the bear's cyclicality fears, regardless of how the legacy business performs.
And the third piece is the forward-looking commentary, specifically regarding that $100 billion AI revenue target for fiscal year 2027. If management can provide quantitative visibility into how they reach that number, whether through expanded contracts or new customer acquisitions, it completely shifts the narrative away from a cyclical peak.
And that guidance is what bridges the gap to the research's blue sky scenario.
Let's talk about that.
Yeah, so this scenario outlines a 2 to 5 year vision where Broadcom fundamentally evolves in the eyes of the market. It requires them to successfully dilute their customer concentration by landing new hyperscalers or maybe sovereign AI initiatives, while simultaneously ensuring their networking silicon growth matches the pace of their ASIC adoption.
And if they execute on that and utilize the $30 billion in free cash flow to aggressively compress that $65 billion debt load, the result isn't just higher earnings. The research suggests a complete multiple re-rating.
Because historically, semiconductor manufacturers are bound by cyclical boom and bust hardware multiples. Investors cap the premium they're willing to pay because they know a demand trough is always inevitable.
Right.
But if Broadcom proves their custom AI silicon and networking integrations are actually permanent, highly sticky engineering partnerships, they break out of that hardware paradigm.
They start getting valued on a stable, recurring platform, multiple, much closer to an enterprise software company. The market begins to treat their revenue as like a utility toll bridge for global AI compute, rather than a volatile hardware sales cycle.
That paradigm shift would mathematically raise the valuation floor of the entire company. It's the transition from being viewed as a parts supplier to being viewed as critical, irreplaceable infrastructure.
So to recap for you listening, we have a highly complex, high-stakes standoff here. Broadcom is executing at an elite level, generating tens of billions in free cash flow through a highly efficient fabless model, and they're locking in massive contracts with the most important tech companies on Earth. But they are dragging a $65 billion anchor of debt. Their customer base is precariously concentrated, and they are fighting a pervasive market fear that the AI spending frenzy is a bubble waiting to burst.
And that September 2nd earnings call will be the flashpoint. It's where the unstoppable force of their current cash flow meets the immovable object of market pessimism.
Absolutely. And looking at all the mechanics we've unpacked today, the deep integration, the co-engineering, the astronomical switching costs, it leaves us with a fascinating, unscripted variable to consider.
What's that?
Well, if Broadcom's engineering teams are permanently embedded inside Google, Meta, and OpenAI to design these custom chips, who is actually accumulating the most valuable intellectual property over the next decade?
Oh, that is a phenomenal question. I mean, the hyperscalers are essentially outsourcing their most critical hardware evolution.
Exactly. If this co-engineering continues for years, Broadcom might accumulate such a deep proprietary understanding of everyone's AI architecture that the power dynamic fundamentally flips.
Yeah, the risk might not be that the hyperscalers leave Broadcom. The real risk might be that the hyperscalers become entirely dependent on Broadcom's institutional knowledge just to function.
Right. If Broadcom becomes the ultimate gatekeeper of AI hardware IP, the current valuation might not just be justified, it might be radically underestimating their future leverage. It's definitely a dynamic worth watching closely. Thank you for joining us on this deep dive into the mechanics of the market. Keep a sharp eye on that September 2nd data, and we will see you next time.